This is a review of dollar value LIFO. Dollar value LIFO is one of the most feared calculations by accounting students, and it takes a while to understand it. Uh, for example, in our previous discussions regarding perpetual inventory and LIFO valuation, we've assumed LIFO was applied to specific units of inventory with specific costs. Therefore, the layers are the units and the layers and the cost are pretty easy to identify. However, in dollar value LIFO, it's a bit different because in basically dollar value LIFO, it can be applied across groups of inventory items that are substantially but not necessarily identical, and we can have multiple groups. In accounting, we normally call these groups pools. Now, one of the reasons, as a matter of fact, dollar value LIFO is one of the most popular methods of calculating inventory because record keeping is simplified under the circumstances because all goods in the beginning inventory pool are presumed to have been acquired on the same date and at the same cost. Now let's go ahead and take a look at dollar value LIFO basics and price indices. Now let's go ahead and take a look at our first dollar value LIFO, a fundamental calculation of dollar value LIFO. And it's basically deriving a price index. Now, as I had mentioned, we don't use physical units in calculating ending inventory at all. We view inventory as a quantity of value, in other words, the total inventory value, instead of a physical quantity of goods. And what happens is that under dollar value LIFO, as I mentioned, we create inventory pools by combining a large variety of goods which are similar into one pool. We can even have multiple pools. Now, the thing that makes this different is instead of layers of units from different purchases with different prices that we can identify, the DVL or dollar value LIFO inventory pool is viewed as comprising layers of dollar value from different years instead of units applied to unit costs. So we're talking about total dollar value from different years. Now, what we want to do is then, in order to determine whether a layer has been added or has been liquidated, we need to compare the changes in our inventory layers in terms of constant purchasing power. As an example, if we look at inventory values today versus inventory values 10 years from now, we know there's going to be some type of change, either be purchasing power or other valuation type of changes. And what we'd be doing is, if we're trying to compare the two, we're trying to compare basically apples with oranges, and we can't do that because we have to identify layer changes. So we need to compare changes again in terms of constant purchasing power. And the way we do that is through creating a price index. And a price index is where the value of the ending inventory pool, we compute it as if it were costed at the base year. And that's for each year after the base year. So under dollar value LIFO, changes in inventory are measured in terms of dollars in constant purchasing power rather than, as I mentioned, units of physical inventory. And again, that is going to require a specific index for each year. Now, the index indexes that are selected can come from several different sources. As an example, an entity may choose to use some form of published index as they want to make sure, as long as that index is somewhat applicable to their inventory pools. Examples would be like the Consumer Price Index or indexes published by trade association. However, the vast majority of companies, when they compute dollar value LIFO, use internally generated indexes, and the most popular of these are called the double extension method of generating indexes. So let's take a look at this particular example right here. We have years 1, 2, and 3. And the total current year in cost at the end of that current year, we show $60,000, $70,000, and $80,000. Well, in trying to compare the changes between those inventory values from year to year, it's literally impossible to do that because there are price level changes which are not valid, changes in inventory. Basically, they're not valid changes in inventory values. We're not comparing them back accurately to the base year. So what we have to do is we have to convert those current inventory values to base year values. And here's an example. In year number 1, our total year-end costs were $60,000. When we take those costs and we convert that inventory back to as if it was produced and valued in a base year, that cost would be $50,000. In year number 2, we have a current value of $70,000. Again, if we had to convert that back to that same inventory back to our base year cost, that inventory would have been valued at $40,000. Year number 3, $80,000 current year value, and if we had to convert that inventory back to a base year, it would be $50,000. So now what we can do is we can calculate price indices basically between the base year and our current years. We take a look at year 1, and what we see is, as far as a price index goes, we take our $60,000 total year-end cost, or valued at year end, and we compare that to that same inventory if it was valued at our base year cost. So it'd be 60,000 divided by 50,000, which would give us a price index of 1.2. Year number 2, what happens is, again, we look at the value of the inventory being $70,000, and we convert that inventory, that $70,000, to what it would be with our base year costs, which would be $40,000. So now we chain together these two inventory values and costs, and we get the $60,000 inventory from year 1 plus the $70,000 inventory from year 2 divided by the inventories from year 1 and 2 that are converted to the base year. We do the same, and we come up with 1.4. The same thing we do for year number 3. In this case, we take our $80,000 inventory valued at current cost, and we revalue that $80,000 inventory back to our base year of $50,000. Now we chain these together and say $60,000 from our current year cost for year 1, $70,000 for year 2, $80,000 for year 3, and that's divided by the inventories that we've converted, those inventories that now we converted to our base year cost, which are $50,000 plus $40,000 plus $50,000. Again, we come up to a price index of 1.5. Obviously, our base year, which we would probably call year 0 in this case, would be the price index would be 1.0. So now let's take a look at the process and how we actually go about converting the inventory. The reason I want to present this separately is sometimes you're going to get exam questions simply on price indices and how to compute them. So you ought to take note of this slide and memorize or understand the steps on how and why you create a price index. Now we're going to go with the next slide and look at how we take the price, or basically how we're going to apply price indices against our inventory values, and then eventually create a LIFO inventory valuation. We start with our inventory in the current year at current year-end value. Now, in order to, again, create our inventory, to convert our inventory from current year value to base year value, we need to apply the conversion ratio, which we did which we calculated in our previous slide to arrive at current inventory valued, but at our base year cost. So then we're comparing apples with apples. We then want to compare the current year inventory at our base year cost to the value of our previous, in this case I'll just say our previous inventory, which is also valued at our base year cost, to see if there's any change between the two. Okay, then we determine if there has been an increase in inventory compared to the within the base year cost compared to the previous inventory value. And if we have an increase, what we're going to do then is we're going to add that base year layer, or that new layer at the base year, basically add the new layer to the previous layers that were computed at their respective base year conversion indices. If they decrease, we're going to subtract or liquidate against the most recent previous layers. And again, we're doing the most recent previous layers because we're talking about LIFO valuation, again, computed at their respective base year conversion indices. So now we're still working in base years. So what we need to do then is we need to convert each of those base year layers back to the current years using the price indices. So we basically convert each layer to LIFO at its own yearly price index. And then the converted layers are added to inventory value at LIFO. Now, I know this probably doesn't make a ton of sense because it's just nothing but words. We're going to go through several different applications of dollar value LIFO calculations, and hopefully it'll become much clearer. So if we take a look up in the upper left hand corner, we have created some price indexes. 1/1/2006 is obviously our base because it's 1.0. We also have 12/31/2006, and it shows basically our cost index now is 1.06. And again, that's determined by converting current year prices for the inventory pool, in this case pool, to base years. Now, if we take a look at January the 1st, as a matter of fact, let me back the slide up. If we take a look at January the 1st, 2006, we see that our inventory at its current year-end cost was $800,000. Now, since this is our base year, we take our base cost conversion ratio, and it's 1 divided by our base cost index. So it's 1 divided by 1, so it's 100%. So we take the $800,000, column A, times column B, 100%, and we convert it to our base year cost. And that makes sense since we were saying the $800,000 is our base year cost. Now what we do is, now we have inventory now that is valued at our current year-end cost, $860,000. But now we need to convert that back to our base cost, utilizing our base cost conversion ratio, again 1.06, and the calculation is $860,000, our current cost, times 1 divided by 1.06, and that comes out to $811,320. Now what we find here is then that since we've converted our 12/31 inventory and compared it against our 1/1 inventory using the same base cost, we find out our inventory cost at base year increased by, in this case, $11,320. So in this case, we know we've had some type of increase in our inventory layer. So in this case, what we do is we analyze that layer and we say, okay, $800,000 was from our base year. The remaining $11,320 was from our 2006 layer now that we've added. So the total amount comes out to $11,320. But since these are stated in base year costs, we need to convert them into current year costs to get to our proper dollar value LIFO. So we do that by taking our $800,000 layer in this case times 1, because that's our base year ratio, 1. So 800,000 times 1 equals $800,000. And we have to convert the $11,320, which is our 2006 layer. And in this case, we're going to convert it using the index of 1.06. So $11,320 times 1.06 equals $12,000. So what we have is our ending LIFO valued in inventory is equal to $812,000. Now, if we want to make a journal entry to record this LIFO inventory, remember our inventory is being recorded at weighted average. So we got to convert our weighted average inventory back to LIFO cost. The way we do that is we take our inventory per our current year cost, which is the $860,000. From that, then, we subtract out the ending inventory at LIFO value, which is $812,000. The difference between the two is what we call the LIFO reserve. And the LIFO reserve is a contra account to the LIFO inventory account. And here's a journal entry we would make. We would credit LIFO reserve for $48,000. So when the contra account is applied against the inventory account, it does show a net value of $812,000. And then the cost of goods sold goes to $48,000. And that would be how we calculate the first iteration. Let's go to another iteration of calculating dollar value LIFO on the next slide. Okay, now in this case, now we've added another year, and doing our calculations again, this was determined by converting current year prices for the inventory pool to its base year prices. So in this case, now our cost index for 2007 is 1.14, and our cost indices for 2006, 12/31 remain at 06, and our base year remains at 1. So here we see we have inventory at our current year cost of $950,000. So now we take the $950,000 and we multiply it times the 1 divided by 1.14, and that this equation here should read A times B, not A divided by B. So it'd be 950,000 times 1.14. That's going to come up to a value when we're converting that $950,000 back to the base year. That's going to be a value of $833,000. And what that tells us, if we compare the $833,000 to our previous year, it was $811,320. So we've had another increase. And we have to add another inventory layer at base cost. And again, the way we do that is we take our $800,000 we know was at our base cost. We added in our $11,320 at our 2006 base, and then now we have $22,013 remaining, which is the amount of inventory layer that we're adding at 2007. Now again, let me catch up with my work here. In 2007, what happens is that we need to convert these base year numbers back to our current year basis to do our LIFO valuation. So we take our $800,000 base year, multiply it times 1, it comes up to $800,000. We take our $11,320 2006 base year to multiply times 1.06, it comes up to $12,000. We take the $22,013 multiply in for our 2007 base year, and we multiply it times 1.14. It comes up to $25,095. So when we add all three of these layers together, we come up with a total of $895,000. Now again, we're going to have to convert our current inventory value per our books to our inventory, our LIFO inventory level. So the way we do that is We take our inventory per our current year, which is $950,000. From that, we subtract out our LIFO value of $837.95, which is right here, which means in order to take our $950,000 down to our $837,000, we need to have a LIFO reserve of $112,905. Now we have to remember in our previous year we had already recorded a LIFO reserve of $48,000. So we're part of the way there to the $112,905. So in order to increase our LIFO reserve from $48,000 to $112,905, we're going to have to add an additional $64,905 to our LIFO reserve. And here you see the journal entry, credit to LIFO reserve $64,905 and a debit to cost of goods sold $64,905. Now let's go on to the next iteration of this calculation. And in this case, what we want to do is, again, we're now looking at the 2008 inventory. And in this case, when we did our calculations, we determined 1.21 by converting our current year prices into for the inventory pool to our base year prices, and it comes out to 1.21. All the other indices remain the same. So in this case, our inventory at current year cost is $980,000. So again, we take the $980,000 times 1 divided by the price indice of 1.21, and that converts back to $809,917. Now, if you'll notice, we do have a difference here between the previous two iterations. In terms of, we're looking at our change in our base year cost between our previous inventory and the current inventory. And what we're seeing is that our inventory is actually, in terms of base year, is lower than it was in the previous year. Now, what that means then is our inventory is costed at base year is less than the previous amount, and that the amount in our new year is $809,917 versus the previous year. It was at a base year, it was $833,333. That means the inventory in base year prices and base year value has decreased by $23,416. Therefore, we're going to have to eliminate certain inventory layers because we're eating into those layers. And what we do is, since we're using LIFO, we eliminate the last layers that we're in, we eliminate them first. So what we're going to do is we're going to take the 2007 layer, the $22,013, and eliminate that entire layer, and that will be now 2007 will be equal to 0. We also then will eliminate a portion of the 2006 layer to get to our total inventory decrease of $23,416. So we're going to eliminate $1,403 from our 2006 layer. Now we have two layers remaining, $800,000 from our base year and $9,917 from our 2006 base year, and 0 from 2007. So now we have to convert those base years back to our current years to arrive at the LIFO calculations. So we take our inventory level at their base year cost, 800,000 times the base year index of 1, that's 800,000. We take now the $9,917 that is remaining in the 2006 layer, and we convert it at 1.06. So now our inventory layer is $10,512 through 2006. 2007, the inventory layer is equal to 0. So we add those items together, and in this case, now the inventory adds up to $810,512. Again, the inventory per our financial record shows a balance of $980,000 $980,000. So we have to subtract out a certain amount of LIFO reserve in order to get to the $810,000. So again, what we see is our inventory per our current year-end cost is $980,000. We need to reduce our inventory to $810,512. We're going to need a LIFO reserve equal to $169,488 to achieve that. Remember that we've already reserved $112,905 from our previous reserve calculations. That means we have to add to the LIFO reserve $56,583 to bring the LIFO reserve up to the $169,488. So our journal entry is a credit to the LIFO reserve and a debit to cost of goods sold. Now we're going to do one more year just to keep going with this example. And now we're in 2009, and again, this was we got the price index is 1.27, and it's determined by converting our current year prices in this pool to our base year prices, 1.27. So in this case, again, our inventory at current year cost is $1,050,000. Now we got to convert that to our base year in cost. And again, what happens is we take our $1,050,000 and we multiply it times 1 divided by our price index. So our conversion to base year cost is $826,772. Now we compare that to our previous layer, which was $809,917, and we know it's increased by somewhere near $25,000 or $26,000. So now we have to account for those layers. So our our base year layer is still let me go back here for a second. Our base year layer was $800,000, so we've accounted for that. We also account for our 2006 layer of $9,917. So now we have to account for our 2009 layer. Our 2009 layer, and that has to take us to the 826,772. So in order to do that, our 2009 layer will be $16,855. So we take all three of these layers, 800,000 times 1.0 equals 800,000. $9,917 times 1.06 equals 10,512, and $16,855, which is our 2009 layer, times 1.27 equals 21,406. And all three of these layers added together now come up to $831,918. That's the value of the inventory at LIFO. Again, we have to take the inventory at their current cost, which is $1,050,000, and then we have to subtract our inventory at our LIFO cost to arrive at our LIFO reserve. So in this case, the LIFO reserve is going to have to be $218,082. Again, from our previous slide, our LIFO reserve was bumped up to $169,488. So we're almost there, but not quite up to the $218,000. So we have to add in another $48,594 to our LIFO reserve, and the entry would be credit LIFO reserve $48,594 and a corresponding debit to cost of goods sold. Okay, now let's take a look at some questions regarding retail dollar value LIFO. Question number 1. Estimates of price level changes for inventories are required for, and you're given 4 different types of basically inventory valuation methods, and I suspect right now you'll get this one pretty correct. Go ahead, if you have to, stop your video. If not, go ahead, either start it or just keep it going if you want. Okay, and the answer in this case is estimates of price level changes for inventories are required for B, dollar value LIFO. Okay, let's try number 2. Number 2, dial Company adopted the dollar value LIFO method as of January 1st, year 4. A single inventory and internally computed price index are used to compute Dial's LIFO inventory layers, very common. Now, Dial's dollar value inventory follows as, and it asks then, what was the price index used to compute Dial's year 2 dollar value LIFO inventory layer? So the cool thing about this is you don't have to go through an entire dollar value calculation. All it's asking you to do is calculate the price index used to compute year 2 dollar value LIFO inventory layer. So go ahead, do your computation, stop your video. Okay, number 2. What was the price index used to compute Dial's year 2 dollar value LIFO inventory layer? And what we see here is the answer is C, 1.33. And if we go through the calculations, we start out with our base year, which is going to be 1, which is basically our base year is the 90,000 divided by the converted cost, the concurrent cost divided by the current cost. Of course, that's going to be 1. If we go to year number 1, again, we're going to chain these together. We're going to take the $90,000 from the base year. We're going to add the $30,000 current year cost, also, and then we're going to divide by the current year base or the year 1 base year cost and the year 1 converted back to the base year cost, which would be the $20,000. We're also going to do that for year 2. And in year 2, what's going to happen is, again, we're going to take the $90,000 current cost, the $30,000 current cost from year 1, and the $80,000 current year cost from year number 2. We're going to divide that by the quantity, the $90,000 base cost. We don't have to convert that because that's our base year. But then our year 1 cost, which is converted from the $30,000 now to the $20,000, we add the $20,000 in, and then we take our year 2 layer cost, which is now we convert back to our base cost of $40,000. So we do the division and it comes out to 1.33. And that's the answer for 2. Let's try number 3. Now here it's asking, again, what was Magnum's dollar value LIFO at 12/31? And you're given the information to do the calculations. Again, this may take you a few minutes. If you have to, go back, look at the previous slides to see how that's calculated. And when you're, go ahead and stop your video. Okay, number 3, Magnum Industries adopted the dollar value LIFO inventory method as of January 1st when its inventory was $500,000. So that's also, we can pretty much, that's its base. Magnum's entire inventory consists of a single pool using a relevant price index, 1.10. Walt determined that its December 31st inventory was $577,500 at current year costs and $525,000 at base year costs. Now you notice you don't have to calculate a base year in this particular case. It's already given to you. What was Magnum's dollar value LIFO at 12/31? And again, the answer would be B, $527,500. And again, this calculation is actually pretty deceptively simple. We take our base layer. We only have 2 cost layers we have to worry about. We know we had a base layer at $500,000, and when we convert that base layer back to the base year cost, that's going to be a conversion ratio of 1. So our inventory LIFO layer value would be $500,000. Now our other layer is going to be, our first layer is going to be where our inventory had a base year cost of $525,000. So what we're seeing is if our inventory had a year-end ending inventory of $520,000 at base cost, that means that we had a $25,000 layer that was added in year one. So we take that $25,000 year layer and we use our price index ratio of 1.1 to convert that back to our LIFO layer value, which would be 25,000 times 1.1 equals $27,500. So our inventory value is a 500,000 plus a 27,500 equals $527,500. Now let's try number 4. On January 1st, year 1, Dent Company adopted dollar value LIFO method. Okay, Dent's entire inventory consisted of a single pool. Inventory data for years 1 and 2 are as follows. So you're given all the information you need to solve what is the value of inventory at LIFO at the end of year 2. So go ahead now and stop your video. Okay, let's take a look at the answer for number 4. On January the 1st, year 1, Dent adopted the dollar value LIFO inventory method. Dent's entire inventory constitutes a single pool. The inventory data for years 1 and 2 are provided there, and the answer is basically what's the value of the inventory at the end of year 2 would be C, $241,000. Now let's go over the calculation. Everything here is kind of neatly laid out. So if we take a look at our base layer, was be $150,000. So our inventory layer basically converted back to the base layer be $150,000. If we take a look at year number 1, our inventory at base year cost now would have been $200,000. So we compare the $200,000 to the base layer, and our inventory has gone up $50,000. So we added an inventory layer $50,000 in year 1. In year 2, our inventory at base year cost was now $230,000, and compared to year number 1, it increased by $30,000. So we added an inventory layer of $30,000 for year number 2. Now, in order to calculate the inventory inventory LIFO value layer, all we have to do is we take our base layer, we take the $150,000 base layer, we multiply it times 1, which is our index, so it's $150,000. We take the $50,000 increase in inventory in year 1, we multiply that layer by 1.10, and it comes out to $55,000. We take the $30,000 increase in our inventory layer for year 2 and multiply it times our price index, and that's going to come out to $36,000. So our total inventory LIFO value at the end of year 2 would be $241,000, which corresponds to question C for $241,000. And that is the end to our comments, our lecture on dollar value LIFO.